Good afternoon and welcome to our second webinar in this series looking at the coronavirus or COVID-19. For today, we're going to dig into OPEC and non-OPEC crude production. Again, we're going to combine the two great teams we have here at Enverus, both the legacy RS team as well as the team that has worked hard at Enverus for many years here looking at these same issues. The people that are going to be speaking are Bernadette Johnson from Enverus. She leads our strategic analytics group here and has done a lot of work looking at U.S. supply, and so should be bringing that expertise to the table with us today. The second group is going to be Bill Farren-Price, who comes from the RS background. He spent many decades looking at OPEC, geopolitics, and some of the dynamics that are happening in the back rooms of those conversations today. Obviously very important given the price war that's going on. With that in mind, we're going to kick it off with the discussion around the price war, and specifically what's happening between the Saudis and the Russians and the backstory there. So Bill, maybe you want to just give us the background and your thoughts about what you're seeing and hearing these days.
Thanks very much, Ian. Yes, it's been quite a crazy week in oil markets and in OPEC policy terms as well. As we ran into that OPEC meeting last week, it was clearly Saudi Arabia's plan A that they would managed to achieve a deeper cut in response to the coronavirus outbreak and the loss of demand, and achieve some sort of at least limited measure of additional balance that would keep markets reasonably tight and put a floor under prices. It was always the case that the Russians were reluctant cutters. They have not ever ponied up the full volumes that they've been required to, and in fact their targets have been relatively limited anyway. So perhaps it wasn't entirely surprising when the Russians decided that actually they didn't want to contribute further to cuts, and they actually wanted to resume the expansion on their upstream sector, which has been their central scenario for some time. But what was surprising was that the Saudi/OPEC reaction to Russia's balking at fresh cuts was to actually launch a price war, to go completely 180 degrees the other direction. And that's clearly what happened when they left the talks on Friday, having failed to get an agreement. Saudi Arabia the following day slashed its OSPs very, very dramatically to key markets, particularly those markets where they compete with Russian crude, Europe, for example. And that's what has prompted the huge sell-off that we've seen this week. Following on from that, Saudi Arabia's doubled down and announced plans to supply oil at about 12.3 million barrels a day in April, which is up considerably from the 9.7, which has been the recent average production level. Of course, that means that they are going to have to withdraw crude from stocks because they are not able to produce at the wellhead at that level. But they have also thrown the gauntlet down in the sense that they have announced plans for Aramco to expand its production capacity from the current technical capacity of 12 million now to 13 million. Of course, it's not clear when that's going to happen or how that's going to happen, which fields are going to be developed. But it is a demonstration that the Saudis are absolutely committed to ramming home and projecting power in the oil markets, and they are going to not back off from this. And I think it's fair to say that the Russians neither are interested in backing off. And in fact, the whole OPEC plus negotiation infrastructure seems to have largely broken down now. So the big million-dollar question is, how long is this price war going to endure? Clearly, we don't have an accurate answer to that, but what we can say is that from the Russian perspective, it may well be that they never return to any sort of supportive or cooperative role with OPEC. I think it's more likely that Saudi Arabia and its Gulf allies at some point seek an off-ramp from this policy, but we don't expect it anytime soon. And possibly they are buckling in for periods of low prices as low as $20 Brent for the next 6 to 9 months. And so I think this is not going to be something that's quickly reversed. I think it is going to be a feature for the rest of this year, at least.
Got it. That's a pretty challenging environment here. I mean, I think one of the things that stands out to me is the question of how do we get here? And in the last two meetings in our conversations have really stood out. Both December, there was a little bit of deception and a surprise cut. And then here in March, where it was a much more aggressive stance. Can you maybe walk through how that's played out? And in all your years of covering OPEC, what makes these two meetings a little bit different and interesting to you?
What struck me particularly about Saudi Arabia's policy in this last week or so has been that Saudi Arabia has always tended historically to seek consensus around cuts, to promote the whole point of OPEC, which is to cut production to shore up prices in periods of oversupply, and that's what they were essentially all about last week in Vienna, until it fell apart. What was interesting was that they had hitched themselves to Russian cooperation, and they said simply, without Russia and without non-OPEC, we are not going to pursue these cuts. They could have said, well, you know, we'll make the best of a bad job. The Russians are not on board, but at least we can still roll over the cuts that we're doing and possibly even extend them. They chose not to. And I think what's interesting here is that there was an intervention from the Saudi leadership, from Crown Prince Mohammed bin Salman has been overtly involved in some of these decisions. And I think it's quite a strong and high risk set of strategy that they've opted for, because ultimately, Saudi Arabia needs much higher oil prices to balance its budget. That's not to say that they can't bridge the gap with recourse to reserves, and also and they can issue debt, of course, of course they can also cut their budget. But Saudi Arabia is absolutely, well, first of all, it's involved in a long-term plan to transform its economy and to diversify away from oil, and to do that they need the oil revenue. But the country also requires quite a high level of social spending on wages and so on, in order to maintain stability. And it's always been the case that in periods of low oil prices, the stability of the state comes into question, and that will be something that's ultimately high on the mind of the senior leadership in the country.
And how does that contrast with the motivations that, say, the Russians have and the pressures they might be feeling in this conflict?
That's a good question. The Russians, I would argue, have always been less focused on price, although they have surely benefited from their cooperation with OPEC over the last 2 to 3 years. But they have always been much more focused on market share in their key markets that in many ways they're hardwired to through pipelines, as much as seaborne crude. And actually, if you look at the way that they perceive the evolution of the US shale patch, where every time that they've cooperated with OPEC, they've essentially underwritten the continued growth of US liquid supply, they are beginning to feel threatened by that in some of their key markets, not just in Europe, but also in the Atlantic Basin, but also in Asia. And that, combined with concerns about Gazprom's ability to place its gas into Europe, I think has riled some of the oil companies who are still set upon upstream growth. And really, I don't think the cuts ever sat very easily with the Russian leadership. I think they saw some political utility therein, but ultimately they decided that they weren't going to play ball anymore. And I think it was hardly a surprise. The Russians have always been reluctant cutters, but they did seem to see some value in this broader political project that OPEC Plus had become, but it's all come tumbling down.
That's kind of a frightening shift in the world paradigm. One of the things that stands out is, and your comments earlier kind of alluded to it, is that the Saudis are talking about producing over 12 million barrels a day. The Russians talk about adding 500,000 barrels a day. The Emiratis are talking about adding 1 million. But you also made the comment that you're not convinced that that's necessarily within the sustainable production capacity of these countries. How do you square these numbers that are being talked about with what you think they can actually produce, and what sort of timeframes, maybe, if you can hazard a guess, that's even sustainable?
Well, I think the Russians probably can bring back about 200 to 300,000 barrels a day of extra supply pretty reasonably quickly. The Saudis, there's no question that they are the most flexible of the OPEC of producers. There's no question about that. They, up until recently, they've been producing around 9.7 million barrels a day. I think it's reasonable to say that they could sustain, they'd be running hot, but they could sustain about 10.5 million barrels a day. That's notwithstanding the potential restrictions that they might still have from recovering from the Opaque attacks last September. But 10.5 seems to be a reasonable assumption. Anything beyond that is they have spare capacity, but it cannot be activated overnight. It needs additional rigs, and it needs additional work on midstream and export terminals and so on. And so it is possible. It just will take some time to deliver. And I think the highest we've ever seen them produce is at about 11.3. And still, we're not quite clear whether some of that was withdrawals from storage, because the information around those storage levels is quite opaque. But suffice to say that April is going to be a huge month for Saudi Arabia, 12.3. We think a fair amount of that will come from storage. It'll be very interesting to see what they do in May and June, and whether those sorts of levels are sustained, or whether they fall back to a more sustainable wellhead production level.
Got it. So we got a number of questions coming in, and I'm going to hold those to the end here. So please, if you do have questions, do submit them. I'll try and consolidate them and make sure we get them answered through here. But before we leave you, Bill, I think one of the things that we forget about in the context of Corona and this very overt war between two of the producing powers is Libya and Iran, and so this backdrop of other barrels that are off. Can you just quickly touch on what you're seeing, what you're hearing there, before we shift context to the other parts of the world that might be affecting the balance?
Yeah, sure. I mean, obviously, we've got about 1 million barrels a day offline in Libya at the moment. That came off in January. Obviously, any political breakthrough, it doesn't even need to be a full breakthrough. It could just be a localized deal that allows the export terminals to reopen, and therefore the fields to start producing to them again. Would obviously add even further pressure to this picture. And then, of course, we have Iran, which has probably at least 1.6 million barrels a day of exports shuttered at the moment due to US sanctions. It's not inconceivable that if we had a change in the White House come November, that we could see the Iran nuclear deal reinstated and Iran's ability to export at capacity resume. That wouldn't happen overnight, of course, but in previous recoveries, Iran has actually come back to the market reasonably quickly, certainly within 6 to 9 months. And so that would be a potential additional challenge to incorporate those barrels into a market that at the moment is incredibly oversupplied. Venezuela is another case in point. I mean, we've seen Venezuelan production recover in the last few months as the country has managed to arrange supply of diluent so that it can produce more from its Orinoco extra heavy fields. That is a trajectory that may well continue through the rest of this year. We have to watch and see.
Gotcha. All right, I'm just gonna touch on a couple other pieces. We'll come back to this topic, I think, in questions, given what's stacking up right now. But before we get into that, we want to talk a little about that non-OPEC and production growth. And for sure, the U.S. is probably the central feature of that. But there's also a long tail of other production that we've spent a lot of time in our company talking about, which we describe as no-CAR. So this is non-OPEC, non-Canada, non-America, non-Russian production. For those of you who are not familiar with it, it's about a quarter of the liquid stack, and this map here tries to give you a sense of where those locations are and really just how much of the global landscape is actually this supply base. So quick definition for you. Again, non-OPEC, non-Canada, non-America, and non-Russia. Now, this wedge of production has been stubbornly stable over the last few years here. And I think a lot of the conversation, and certainly the bull cases I've seen, has been around this wedge really declining in earnest as you see appraisal activity and exploration activity and the CapEx in general come down in these regions, but it just hasn't shown up. And that's even more amazing when we start to dig into some of the base decline work we've done in certain areas. A lot of numbers come up in different places, but when we go and dig down and look at individual wells and try and stack it out, we actually get to somewhere in the mid to high teens, even 20% base declines in some of these regions. So significantly higher than some of the figures that we've seen out of the IEA and others that would suggest 6%, 9%, something that is maybe a little bit more manageable. So this is both bullish and bearish because we both see a faster treadmill. That's exciting or maybe helpful, but also in spite of that treadmill, we've seen relative stability. And one of the ways you can understand that is thinking about the long lead times of the big mega projects that make up much of the stack. A graphical representation of that is something like this. We're looking top to bottom sequentially by year. The width of these bands is just a proportional representation of resource discovered in that area by year. And so you see these sort of pulses through time of new resource. Think of it like a Cambrian explosion of life, but in this case, it's an explosion of production that follows. Recently, though, we've seen a number of new explosions, particularly in pink, Brazil, pre-salt. We've heard about that a lot. Some of that, deeper segments of the Gulf of Mexico, that lower tertiary and even deeper, like the Norphlet play. And then very recently in Guyana and the great success that Exxon and its partners has had in those regions there. So this is sort of like a wedge of production that is quite supportive to what's happening in this NOCAR region. And to illustrate just how significant it is, if we just pick 35 of the biggest projects that are due to come on stream over the next few years. Now, this is not every project, but it's 35 of the biggest ones that we're looking at. You get this stack here. And so the pink wedge is a series of FPSOs and projects in Brazil. The purple is Guyana. You get some North Sea in there, a little bit of Mexico. But all told, you're talking about 3.5 million barrels a day of new production out of just these projects over the next 5 years. And that's significant if you think about it in the context of the rest of the wedge. And just to see how significant, let's just focus on the top of that envelope there. That's this green line here. And so we're looking at cumulative changes through time. If I look at the rest of the NOCAR stack, it's the pink line in behind here. So very much in decline, exactly as we would expect. But when you net those two things together, you kind of get this gray-white line in the middle and a stack of production that is relatively stable. Right? And because of the long lead times and because of how these projects are structured, they're not that sensitive in the short run to production. And so our view, at least the next couple of years, certainly in the time frame in which Corona is most acutely felt and the time frame in which the price war is most acutely felt, this wedge of production is unlikely to be the really big accommodating factor. Now, there's another wedge like that in the United States. It's the Gulf of Mexico. This is our production stack here too, field by field, project by project. You can see where the EIA is here in the red dashed line. I think both metrics here, we see, maybe subtly more growth than they do in the medium term, but, again, relative stability backstopped by large projects. And if you remember that earlier slide on the Cambrian explosions, another region where that's really been, benefit from that, and it's playing out on the production side. So with this backdrop of relative stability, we come back to the US and US onshore. And with that, I'm going to turn over to Bernadette to touch on some of the things she's seeing and thinking about.
All right, perfect. Excuse me. So let's get started, shift gears and talk about the US. If we start by looking at break-evens, what does this look like? So you've essentially got, when we look at the US, we break it up into 500 different slivers of production. So we're fitting type curves, we're calculating half cycle break-evens, and this is the data that you see in front of you. So what does this tell you? In the box, we've basically put a box around the areas of the country that have a break-even at $45 or below. And that's the chart that you see off to the right as well. Those are the areas where, even at today's pricing, right, there's some areas that are not in the money where we could expect to see some rigs lay down, and we've already heard that producers are pulling back activity. But then there's also some plays, some specific formations that are economic at even these very low prices, but it's not very much. So these bars are color-coded by basin. You have the Permian in red, you have the Anadarko, you've got the Eagle Ford, you've got the Williston. The Williston, you actually see a fair amount of those smaller plays within the Williston pop up near the best economic area. Interesting though, because the Antelope, that lowest break even, that one, very small area, almost completely drilled up, very little drillable locations left. So there's definitely a story within this around how much activity can continue to move despite these low prices. The other takeaway that I like to point out on this data is, if you think a couple months ago, where were we sitting in terms of price, $55, $60, there's a lot of those areas that come into the money between where we are today and $60, and certainly more between 60 and 70, and then on up the supply curve. So those are the areas where today we're focused and we're tracking to see our rigs laying down, the economics which suggests that, how much activity is being cut, are we going to see the DUC count build while they push off bringing those wells in line until prices recover. Those are the various things that we're tracking very closely, and you're seeing announcements from operators daily at this point. What about US production? So what does that mean for US production this year? So the hard part is you just saw not a lot is economic at these prices. This is our US production forecast. So how do we do this? We track operator guidance for 70 plus operators that come out and tell you how much are they going to spend this year, how many wells do they intend to turn in line, and we're taking that as the basis of our short-term forecast. So before this price collapse, the price war started, we had just heard earnings calls, guidance from the vast majority of operators, and we took that information and then we adjusted it down based on the announcements we've already heard this week from several operators. And this is how we get this forecast. So what does that mean? December 2019 to December of 2020, we're expecting growth of 260,000 barrels a day. This is definitely, I would call, a ceiling. We're going to continue to revise that number down as we get revised guidance plans and CapEx plans from these operators. But if they do what they said they were going to do in the earnings season, adjust it down for the announcements that have already been updated, this is the number that you get. Where those wedges are that are growing, it's broken out by basin. So the Permian, that blue in the middle, that's really the one where we're expecting to continue to see some growth. The other major plays, flat to slightly declining. And then you have the rest of the US, which we do expect some slight declines, offset by some Gulf of Mexico growth. What announcements have we heard already? So many of you on the call, I'm sure, are hearing these announcements, tracking them in the news. We've heard both rig reductions, CapEx reductions, but also frac crew reductions. So this is a highlight of what we've seen so far. So Diamondback, Parsley, PDC, Matador, Marathon, Ovintiv, Murphy today, Apache today, Devon, Oxy. You roll this up and what are we tracking towards? We are already tracking towards announcements that 30 to 50 rigs are going to come off. And this is just the beginning. So will we get more announcements today, tomorrow, over the next several weeks? We think so. So that's something to track, that we're tracking closely. We also ran some scenarios for what is our view of production and what does economics dictate. If you drilled economic wells and you didn't drill uneconomic wells, what would that mean for the global crude and other petroleum products supply-demand balance? So this is the first scenario. And this is what we did is we took the IEA data, we updated it with Monday's data release, and then we pulled out the US piece and we put in our own US estimate. And this is what happens if the US does grow 260,000 barrels point to point that we just told you. You would see that dark line on top, that is supply, the lighter blue is demand, and you see a really wide gap. So this is another signal that tells us that's not likely to happen. You're going to see that 260 come down, or you're going to have to see a very significant change in this demand story, because prices will do whatever they need to do to fix this. You cannot have that gap persist for all year without blowing through storage, both floating storage, onshore storage, all around the world. So this is very quickly developing into a prices continue to drop situation to push additional supply out. You look at that, those columns, they're basically illustrating the difference between those supply demand lines. So if you look at that Q1, that's 3.3 million barrels a day long. So our estimate, based on some growth we're still seeing from the US in the very short term, 3.3 million barrels a day long supply right now. And so again, that is not a sustainable level. We may see additional price pressure to push more supply out of the market. This is the second scenario. So this one basically says, We continue these CapEx plans through about June because a lot of this is already in flight. Rigs are active, they're drilling wells. There is a typical 3 to 6 month lag between when you drill a well and when you bring it online. Some of those wells will still come online. Some may be pushed into the DUC count, but some of those wells are going to happen. So let's continue that path to June. And then you start to see more activity come off, rigs lay down, wells not brought on based on economics. You don't drill wells that are uneconomic, or you don't bring them online. You do bring online wells or drill wells that are economic. And that's what you get here. That's the difference in that top supply line. And so that's meaningful. That means the US, we could lose 1 million barrels a day just really between June and the end of the year. And so that certainly doesn't fix the balance overall, because you still don't see supply demand coming together, and you certainly wouldn't erase the stock build that's going to happen between now and then. So this is part of the solution. But again, you're going to hear a lot of focus on shale dramatic declines and what that means for the future of pricing. And this is a short-term outlook that would tell us this. The longer this sustains, the longer you're going to see these low prices, and this is not a quick thing to correct. A couple more data points, production declines. So at this point, we're going to look at the natural decline rate that you're going to see by operator. We're also going to look at some hedge data and some overall balance sheet data points. So this is production declines, and this is basically from an August 19 data when we have pretty comprehensive data at well level production through August of 2020. And this is really just showing you that natural decline rate if producers stop drilling. So this is their PDP component. They stop drilling, this is what you would see. The green bars are showing you the oil declines. The orange dots are showing you the gas declines. On average, the oil decline within 12 months would drop almost 45%. The natural gas declines would drop about 44%. So that's important. Those numbers are going to be definitely higher than what you would see if you ran this for the whole country, because these are predominantly unconventional operators sitting on wells that decline quicker. So this is not offset by the Gulf of Mexico slower declines or the conventional play slower declines. So certainly something to note there. You can also see the variance. Certainly if you're a newer operator with a lot of newer wells that are still declining quicker, you're going to have a more substantial first year natural decline rate. Who's hedged and who's not? So let's look at some of the data. So what this is basically showing you is I want to highlight the dots on the top of that chart. This is again by operator. So we've gone through at least 63 operators. We continue to update this hedge data. So we'll have more and more data over the coming weeks. But basically we're tracking, are they hedged? At what level are they hedged? And what style of hedge do they have? Is it a two-way collar, a three-way collar, a swap? What does that look like? So if you look at those dots, what you can see is really the hedges that are in place between $50 and $60, right? So that is meaningful. That does provide some protection for the first part of the year. It's not gonna save all these operators, certainly, and there are operators in here that are not hedged, and you see them towards the bottom of the stack. So that's also another important point to note. The difference between the green bars and the orange, that's simply showing you the next 12 months. That's green, so that's the very near term. And then the orange would be a post 12 months out. So right, you don't see very much orange because the hedge coverage is really about this year. Once you get out past that, there's very little hedge protection. Hedge values. So this one, what I want to highlight here is percentage of your 2020 next 12-month oil that's hedged. You're going to see those percentages range pretty dramatically. Some operators are very well hedged, 100% of their supply. Some are not. The difference between the blue bar and the green bar and the orange bar, that really gets to the style of hedge. So at different price scenarios, there's a high price, a base price, which was the forward curve as of Tuesday. That's what we used. The high price scenario is $10 higher for WTI, 50 cents higher for Henry Hub. Then there's the low case scenario. So $10 back from the forward curve and 50 cents back for natural gas. And so when you look at that, you can definitely see the style of hedge matters. Some of those bars are very flat and some of them are not flat. Last couple of slides here, hedge duration. So this is when I mentioned that when post 12 months out, post 2020, that hedge protection starts falling off a cliff. And this data is aggregated up to point that out dramatically, right? So it's oil hedge volume in the green bars, oil hedge price in orange. And you can see as soon as January 2021 hits, dramatically less hedge protection. So this hedge protection that folks are talking about, even the operators that are well hedged, it's relatively short term. And the longer that these low prices persist, certainly more change in behavior that we would predict and more balance sheet trouble. And then finally, this is the chart. It's difficult to read, so I apologize for that. This is those same 63 or so operators. And this is, when I roll it all up and we look at all the details, this is what matters. It's really, what is your debt to EBITDA ratio? How well hedged are you? And how much debt do you have to roll over? So the last three columns in this table, they're color-coded green to red. So red would be bad, green would be better. So if you are more hedged, that middle column is going to show up in green. If you are not hedged, it's going to show up in red. So what you see here is the operators that have high existing debt, a lot of that debt needing to roll over this year, and very little hedges. Those are the folks that are in the most trouble, if you will, or the folks that will be at least the most distressed in this environment. The further up the stack you move, the better it is. So if you are a Chevron, if you're a ConocoPhillips, and you're sitting on a significant pile of cash, you can weather this storm longer, even if you're not as well hedged. If you have a lot of debt to roll over and your market cap just crashed by 50, 90%, that's a significant challenge that a lot of these operators will have to overcome. So that's it in a nutshell.
Awesome, thanks, Bernadette. Lots of stuff there. I guess there's a few questions that stand out when I look at this. The first, and maybe it's just talk my own book here, having done a lot of forecasting on our side as well, I'd say those that have seen some of the RS forecasts will notice they're probably a bit lower than what Bernadette presented here. And certainly in these times of rapid change, it's hard to kind of figure out what's going on in there. But Bernadette, as you think about that, what are some of the key uncertainties and things you're thinking about as we update this and absorb new information for operators? And where do you see the big levers for that production trajectory to change?
Sure, so it's a good question. I would say the 260 point to point is not going to happen. We're going to hear more reductions in activity. If we don't see a significant rig count cut from where we're at today at 820, then that could happen, right? So that's the risk. 820 rigs would put us on the trajectory for significant growth. So that's going to have to change really quickly. And some of it is a couple months already in play, right? So that is what tells us the next few months we're probably going to grow. After that, you start to see a pretty immediate decline.
Gotcha. And I guess another thing that stood out is that just on those that hedge chart there, that protection in 2020 is a fair bit different and stronger than what we might see in 2021. Bill, I think in some of our conversation, your comments, you alluded to the time frame in which you think this price war can continue. Perhaps you can touch on that, just reiterate for everybody exactly how you think this year might look, and if there's any reason to be optimistic around progress there ahead of those hedges rolling off at the end of the year.
Well, in terms of Russia, I'm not expecting Russia to come back anytime soon, if at all. But in a sense, Russia matters less because, as I said, it contributed a limited amount to actual volumes cut. So it wasn't one of the big players in volume terms. It was just a big player in prestige terms and in political terms. In terms of the OPEC countries, it seems at the moment that the Saudis are determined to project their pricing power into this market, and they are, if you like, teaching a lesson to some of the other producers in the process. The other thing that they're doing, which is important, is that if they are going to go back to supply management, they will go back when they've set new higher baselines for cutting from. And that's important because that won't necessarily happen immediately. As I said, it will take some time to activate some of the spare capacity that they maintain. And of course, Aramco now has plans to expand its maximum supply capacity from 12 million to 13 million. And it'll be interesting to see what the time frame is for that when we get some detail on what that actually means. So I think it's fair to say that we probably wouldn't expect to see efforts towards an off-ramp till towards the end of the year. And even then, when we last saw this kind of behavior in 2015, 2016, it did take over a year to get all the diplomatic ducks in a row and make that happen. It was actually quite a complicated and difficult story. As we alluded to earlier, if some of the shut-in OPEC production comes back, that just makes that discussion even more difficult.
Gotcha. So I mean, another thing that stands out a lot is I think when we look at balances and you put the context of demand and coronavirus and how that's evolving and evolving very quickly, I think in all of our understandings, without this price war, I think you can imagine a scenario where the market was going to be oversupplied this quarter and second quarter as well, and there would be some prices or pressure on prices. How do you think that kind of math, to the extent it did, played into the thinking of the Russians and the Saudis and their partners, just in the sense that it's probably the maybe the worst or the best timing possible for a price war?
I think I think that they were aware that certainly the first 2 quarters of this year are going to be seasonally sloppy in terms of the balances. They knew that there would be some price pressure out of that. But as things stood before the coronavirus, the outlook was actually much more solid towards the back end of the year, with demand growth picking up through the second half and tightening up balances as things stood. Obviously, the whole thing has been overturned by coronavirus and the huge impacts that were beginning to emerge, not just in Chinese demand, but also in some OECD countries now as well. And the envelope for those initial estimates on what's happening to demand is so wide at the moment that it's very, very difficult for producers to formulate an accurate response. But let's see how low they go. I mean, I think OPEC producers are ready and waiting to endure a period of very low oil prices. The question is duration. As I said, all of these economies are heavily reliant on oil revenue to fund their basic operations and public spending, and some of them are better placed to borrow money than others. For those who have huge strategic sort of security issues like Iraq and also and other countries that are essentially at civil war, that's going to be a major challenge. Low oil prices as well as low volumes.
Challenge is a good way to put it with the strip where it is. And with that, I think I'll turn it back to Berna and ask about the break evens you presented. I mean, we all look at them a little differently. The price deck today is, low 30s, maybe on a 12-month strip basis, low, 31, I think, for TI. How does that number fit with the break evens you showed, and what's in, what's not, and how might operators have to react to that?
Sure, so that's a good question. You look at that chart, and those are half cycle, so not including land acquisition or exploration costs. So you look at that data, there's very few areas that can work at this price level. A little bit of Bakken, a little bit of Permian, but very little. And again, those Bakken plays are fairly well drilled up. So these are not areas where you have a lot of drillable locations. So that's interesting. I think that is also, when I look at that, I would say shale's not dead. We've fielded a lot of questions this week from reporters. Shale's not dead. The market is essentially working the way that it's supposed to. And we are already seeing operators pull back because of low pricing. As soon as pricing comes back up, you'll be able to see folks return to drilling, add rigs back very quickly, very similar to what they did after the low rig count in 2016 of 433. And when I march up that curve, those are the areas that we're watching, where we should start to see that activity both come down in the short term and then go back up as prices recover. We agree that prices are not going to recover quickly. We are having a really hard time seeing a lot of upside in 2020. But once you get out to 2022, 2023, the world looks different. Demand hopefully has recovered by that point. Long-term demand trends for both oil and natural gas are increasing. A lot of those shale plays can come back in the money. You can have rig counts return. You can start to see the U.S. switch and start growing again very quickly. So that is what we would expect to happen.
In terms of reaction time, I mean, when you model things through, if we're dropping rigs now and reducing activity, how long until that plays out into the production stack?
So I think it'll be about June. We'll start seeing pretty significant activity come off. So we'll see operators put some of these wells that they're drilling today into DUC inventory, hold them for higher pricing. We saw that before, right? Several years ago, we had 5,000 wells in DUC count, just sitting in DUC inventory. And those were wells that were outside of the normal 3 to 6 month production lag. So those are the wells, we call them bad DUCs. We say these are the DUCs that are waiting on infrastructure or higher pricing. We're going to see that count add because they're waiting on higher pricing, and that's what should happen. So that I think it's going to be June. I think you're going to see some of the short-term stuff because producers are hedged. They do have some level of coverage. If you decide to pull back right now as a U.S. operator, you're essentially betting on Russia and Saudi Arabia not being able to solve this very quickly. And so it's game theory, right? If you pull the trigger too soon, even though you're covered, then this is resolved quicker than people are thinking, and you're at a disadvantage relative to your competitors. So those are also the things that we're seeing play out. So I think it'll be June when people really start to realize this is not going to be a quick recovery and start to react pretty drastically.
Got it. Quick technical question for that production forecast you showed. That's all U.S., including Alaska, Gulf of Mexico, or?
Yes, exactly. So we're the other U.S. you saw on the bottom of that chart. That's where we lump in a lot of the conventional plays, or the Gulf of Mexico, or other things, and then we break out on the top the different major plays that were growing previously. But yes, that is a whole U.S. number.
Gotcha. So, I mean, there's another really interesting story. I think that when you look at those balances slides you showed, that the gap is wide, and we have pretty tremendous pressure on the demand side. We have a supply stack that looks pretty darn resilient when you talk through volumes being added through a price war, a no-car stack that to us looks relatively stable, a Gulf of Mexico that looks relatively stable, a quote-unquote short cycle and reactive U.S. production stack that, you know, we're still talking about end of second quarter, maybe sometime in the third quarter to really see some production movements here. I mean, this is a big debate I've had around the shop. Like, where do you see some of those other accommodating forces, and, you know, what happens when the gap is this wide?
So I think we hear it a lot, but the cure for low prices is low prices, right? What's happening right now is what's supposed to happen. If the market is 3.3 million barrels a day long, which is what we showed you for the global crude and other petroleum products market, that has to be fixed. You have to drop the price. You have to knock supply out. The U.S. is the most reactive, right? We're already seeing rigs come down. The U.S., we would tell you, is positioned as the marginal supplier. As prices go up, rigs can get added very quickly. You can drill wells in less than 30 days. As prices come down, you see the rig count react very quickly again, stop that activity and stop the growth of production. So it's functioning like it should. We would look at it and say the other countries, the other areas like this year where we are going to see growth, like Brazil, right? Even the Gulf of Mexico, North Sea. Those are conventional projects, years in the making. Those are already in flight. When you're planning for a project like that, you're planning for the long haul, 10, 20, 30 years out. That stuff is going to continue to grow. And that is going to be one of the main things that stops the market from coming into balance quickly. So that's why we would say U.S. reacts quickly. Nothing else reacts that quickly outside of another black swan type of event that knocks supply out. It's going to take through 2020, probably through 2021, before you see a longer term recovery. I would look at it and say 2023 pricing looks a lot better. At that point, we've missed an investment cycle for global conventionals because pricing has been low for a while. Global demand is growing. There is this fundamental natural decline with that 100 million barrel a day market that you have to invest at a certain level to maintain. So those things are going to catch up to us. The market is always surprised. We're surprised when the prices come down. We're surprised when they go back up. But we track that very closely. We would say 2023, it looks better. This year, next year, it's going to be pretty tough.
Tough. Bill, I mean, what do you think about when you see this kind of pressure on the market and these kind of supply demand balances being so far out of balance? Where are the other parts of the world we should be thinking about?
Well, I think we're in uncharted waters. Like I say, I think the fiscal pressures on producers will be quite telling in quite short order. But whether they're able to negotiate a way out of this is the big question, and I'm not entirely convinced that that's going to be that easy. They're creating a dynamic that creates its own momentum, and I suspect that is going to be a very difficult square for them to, circle for them to square at some point further down the track in this year. The reality is that we are going to see a complete shakeout in a lot of oil producing countries. We may see some of the low cost OPEC producers decide to reconfigure some of their production portfolio. So everything's up for discussion at this point. I think it's really, really difficult to make any assumptions about how this plays out in balances terms, because we've got, as you pointed out at the very top, we've got a huge moving target in terms of the coronavirus impacts, and then we've got the future of this price war. My instinct, as I said, is that this doesn't go away anytime soon.
And you spent a lot of time in that OPEC stairwell, backroom chatter. Like, what sort of sentiments are you hearing from other observers? Because I think, you know, sometimes we lose context for history and the significance of this moment and why it's so different and special in your eyes and others. What are people talking about? What are some of the impressions out there?
Well, I think the difference between what happened in late 2014 when Saudi Arabia kind of took its hand off the tiller and decided to try and let prices fall and try and rationalize some of the growth that they're seeing out of the US. I think this is different this time, not least because, you know, I'm not the expert on the US patch, but it's clear that it's capital constrained. It's clear that the dynamics of the industry are somewhat different than they were back then. But you have to ask yourself whether the Saudi action is really aimed at the US, which I don't think it really is. I think it's more aimed at Russia, and whether the Russians, what are the Russians focused on? I think the Russians are focused on the US. For geopolitical reasons as much as economic ones and oil ones. So there's a sort of complex layer of focuses here that are not very easy to understand and somewhat complex. And I think it's going to be interesting to see how, to what extent those those strategic targets are made clear over the next weeks. And how much they change as the market develops, because as we know, you know, the producers are having to take these prices as much as anybody else, and that will create its own set of dynamics in due course.
Gotcha. So a world of a lot of change and disruption. Services come up a bit here, and you talked a little bit about ducts there, Bernadette. How do you see this playing out down the stack there? Is there any reason to think that the pain's going to be less or more?
So we actually have a fair amount of OFS clients directly. And so now that our combined business is very broad, we're serving folks across the value chain in energy, and not even just oil and gas, but also renewables and everything else. We look at the OFS sector, we track those folks very closely, we're in constant communication. OFS market was having a tough time before the price collapse, just with a pullback in activity. We were running about 1,200 rigs in the US back in November of 2018. By the end of 2019, we had cut that number by 25%. So that was already important. Less activity means less drilling, less need for services, pullback in rigs, pullback in crews. That was already happening. So this really just exacerbates that. And I would say if you look back historically at what happened when prices first collapsed several years ago, it really is OFS that usually takes the hit first. They cut costs, they lay down crews. A lot of the layoffs that you might see might start there. They also can recover as activity comes back in. I would say it's tough to be in the sector. There's some parts of the sector that are doing well despite that, like even the water handling companies, because there's so much water production in certain areas of the Permian, and though some of that activity will continue. But yeah, it's tough for a lot of folks right now, and OFS definitely not excluded.
Got it. It's tough, and I think it's tough to look out at the world and understand what's going to happen. There's a number of questions here about gas and sort of gas balances. I think that's something we're going to try and address in an upcoming webinar and interaction here. So I'll hopefully gracefully pass on those questions there to that moment in time. But suffice it to say, this clearly is something that affects all commodities and all parts of our industry here. So I'm going to ask an unfair question, or at least I think it's an unfair question. As you imagine, and to both of you, really, as you imagine the next 12 months, like, what do you think happens? Like, what do you think that sort of unfolding story is over the next couple quarters? What's going to surprise us?
I'll take a start. I don't know that it's too surprising, but I do think we're going to see a lot of rigs lay down. Are we going to see the drop back to 433 that we saw back in 2016? Maybe not, but could we hit 600 easily? probably below 600, probably. So I think that's going to happen. Not a huge shock, but I think that's going to happen. I also think maybe what might be surprising is this might be the type of event that helps shake loose capital markets. So this is, I've been running this theory by a lot of folks. I think generally we're still on the fence, but if you think about it, a lot of these assets, what was the challenge before? Not a lot of transactions happening, not a lot of money in the space. And now if you look at a lot of these assets or even stocks, it certainly looks like a decent time to get back into energy if you were on the sidelines. Will it be traditional investors? Probably not initially, but there's a lot of folks out there with significant capital where we could see them look at this and say, before there was a really wide spread between the asset bid and ask. The sellers wanted a pretty high price. The investors weren't willing to pay that. Well, now when you rerun those numbers, that bid ask comes much closer together. And now you might see some transactions get done. Assets get distressed. People come in, they're able, because they have a strong balance sheet, to merge or acquire. I think we're going to see that part of the industry pick up. I also think you look at this, that part of the market, capital markets being essentially closed to oil and gas, that market is cyclical just like everything else. So was there going to need to be a big catalyst to start shifting that dynamic? Probably. Could this be the event or the series of events? I think that's on the table. I think that's a possibility.
Mr. Farron Price, what do you see?
Yes, I was going to say the thing that I would be worried about in terms of political risk would be the stability of many of these producing countries. That we already know Iran is under huge economic stress from US sanctions, from its inability to export its crude. And we've seen what that has produced in terms of its influence on neighboring countries and on its Arab neighbors across the Gulf in terms of the attacks that we saw on Saudi oil infrastructure last year. You'd have to be blind not to consider that could be a rising risk in a period of increased stress from low oil prices. And it's also not just going to be a problem for Iran, it's going to be a problem for Iraq and ultimately for the Gulf monarchies themselves. So that is something worth watching. The periods of low oil price have tended to be high risk, high danger periods for stability, for security in this tinderbox region.
That's really interesting because I was just remembering that September 14th was the Opaque attacks. And so here we are almost exactly 6 months later. Instead of sitting here worrying about supply capacity and a major outage, we are, I think, equally and probably even more terrified about new production coming on the market and weakness in demand. So it's quite a change in just 6 months' time. And you alluded to the risk that presents. I think we think about the Saudis and that sort of direct risk, especially in the context of last fall. Are there direct risks that the Russians, for example, should be thinking about, or that you think about, or other major producers?
No, not so much. I think the problems that we've seen in OPEC have all been internal political problems like Libya's civil war. We've seen poor management of national oil sectors in West Africa. We've seen it in Latin America as well. And many of these OPEC countries have contributed to their own demise as major producers in many ways. And that just seems to be part of the trend that we've seen within OPEC countries. I think that trend is unlikely to stop, and in fact, it could be even accelerated because of long duration low oil prices.
Got it. Well, I think there's a couple less questions here, but we might follow up with those directly. Bernadette, Bill, do you have any final words or final thoughts that you want people to take away when they leave this webinar and just think about the messages you're trying to convey today?
Well, my final word would be just to say don't expect a reversion to the mean anytime soon in terms of OPEC policy. I think this is going to take some time to work through, and I think we, in that sense, we may be in for some low oil prices for longer than a lot of people in the market expect.
And I would add on the demand side specifically, That is certainly one of the big catalysts here. Certainly the price war doesn't help, but coronavirus really kicked this off, and the demand trends are still concerning. And you look at the IEA numbers, they did revise their base case down to only slightly higher than 100,000 a day of growth in 2020. Are we going to see some more downward revisions to that? Probably. So is this a year where we see demand actually contract? I think it's possible. We're tracking those numbers very closely. We're still seeing a lot of disruption in terms of travel, overall demand. So that is still definitely concerning and will exacerbate this. So the timeline of that recovery is also still very unknown. The testing seems to be the issue today, and really the understanding from the medical community of how far spread this is. And the next 2 months are going to be really tough in the US. The testing capabilities are not there yet. So that is also an area where I would say a lot of unknown for the next 2 months. Is there going to be some restrictions and travel things continue to play out? Probably. So that is also, I would say, exacerbating this and making it equally as difficult for the market.
I would echo that. I mean, to me, difficult is the word of the day. There are so many difficult, challenging questions, and the magnitudes I don't think have ever been larger. And we're quite fortunate here to have such a broad team and great data sets to try and evaluate that and bring a little bit of quantitative context to these hard questions. So on behalf of the whole team, including the team that presented demand last week and those that are not on the webinar today, really want to thank you for the hour of your time, and we look forward to speaking in the future.